Hey guys, it is Patrick, your San Antonio based real estate agent. And in today's video, we're going to be looking at your mortgage payment. Now, specifically, we're going to look at your mortgage payment from the property tax perspective, specifically on a purchase of a new construction home. And the reason why we're talking about this is that if you buy a new construction home, you might see that the first year your mortgage payment is X dollars, and then you find out that the next year it increases significantly. And the question might be, why was there such a jump from your first year to your second year, especially if you have a fixed interest rate, fully amortizable loan? Why is there a huge jump? Well, this might be the reason. Now, we're going to look at this from a Texas perspective. Why? Well, because I'm based in San Antonio, and I would say that that is the purview of what I know. But besides that, this may apply to any homes in the United States if you're buying a new construction home. But as a good advice to you, my suggestion is to contact your local real estate agent who can talk to you about this and help you understand this issue in your jurisdiction or your area. Now, if you don't know anybody that is a real estate agent in your area, feel free to reach out to me via email or through my website, and I'd be more than happy to connect you with a qualified licensed real estate agent in your area. So if you are ready, let's talk a little bit about what this deal with new construction, mortgage payment, and property taxes have to do with an increase in that mortgage payment. So in Texas alone, property taxes are paid in arrears, meaning that you get the use of living in your home for a year, and then at the end of the year, you have to pay property taxes for that year. So it's not like you're prepaying taxes. You're basically paying that tax bill after you've gotten the benefit of living in that home. Now, from a timeline perspective, this is kind of what it looks like. So let's assume that on January 1, well, this is actually the timeline. So on January 1, this is the assessment day in Texas. And what that really means is that's the day that your home is assessed. Now, there's a difference between assessed and appraisal. An appraisal is when an appraiser comes in and looks at the market and says what your home is worth based on the market. An assessment is what the county assesses your property at for property taxes. And one of the things to know about is that the assessment and the appraisal typically are very different. Now, when I mean very different, I don't mean that, one's 100,000, one's 200,000, but there is a difference between the assessment amount and the appraisal amount. So we don't want to confuse those two. But on January 1, each county is supposed to assess your property's value. And the reason why they're going to do that is they're going to do that to calculate the property taxes that you owe for that year. So for instance, on January 1, X1, the county is going to appraise your property. And once they appraise the property, then they can apply the tax rate for the area that you're in, and you'll know kind of by the middle of the year how much taxes you're going to owe at the end of X1 in this case. Now, the tax collection period varies, but generally in Texas, it starts on October 1st, 20X1, or October 1st. That's when they send the bill out to you. And then depending on what payment plan you might be on, there may be a certain period of time in which your taxes are due. For most properties in which they make one payment rather than multiple payments, that is due at the last day of January 31st of the next year. So you have a little bit of time from when you receive the bill to when it's due. That's the tax collection period. Now, when it comes to new construction, what happens? Well, if you, let's say, purchased a property on July 1, it's important to understand what the property was here on January 1, X1, because I can almost guarantee you, if you purchased it on July 1, the builder was still building it as of this date. And so as they were building your home, the home wasn't a complete building on January 1 of that year. So when the assessor came out and they looked at the home, they go, well, there's only the frame and the foundation, but there's no walls, there's no roof, there's no landscaping, there's none of that. And so they go, okay, well, maybe this property is assessed on this day at, and I'm just pulling out a number, $100,000, okay? But then you purchased that property on July 1 for $250,000. So in a sense, you're kind of getting the benefit because they've assessed the property at $100,000. So you're going to get the benefit of an assessment of $100,000 for the year, even though by the time we get to July 1, when you purchase the home, it's actually worth $250,000 because that's what you paid for it. So we've got this disconnect. But what happens that following year? What happens right here on January 1, 20x2 or 2x2? What happens on that date? Well, what happens on that date is your property is reassessed by the county and they go, hey, there is now a home there. There's walls, there's paint, there's a roof, the landscaping. So it's not worth $100,000 anymore. It's not going to be assessed at $100,000. It's now maybe going to be assessed at $225,000. And so they're going to assess you at a higher rate for that next year, which also means your property taxes go up. So it's important to understand, as we're talking about this, why there might be a jump. We're going to jump from here to here. That's an additional $150,000 of assessment. And if we have a tax rate of 2 or 3%, that's going to definitely increase the amount of property taxes that you're going to owe. And most mortgage payments is going to include principal, interest on the loan. That's going to include your property taxes, your homeowner's insurance, and maybe your mortgage insurance as well. Well, a key aspect is that property tax. So if your property taxes increase, that means your mortgage payment is going to have to increase as well. Now, let me give you my personal experience, and I'm going to show you actual documents about my assessment of my new construction home that I purchased in the last year. So this right here is kind of the assessment report, you could say, of my home over the last 2 years. So in its first year, and I say first year because they replotted the area. When they replotted, then it kind of starts back at 0. But when they replotted it, this property was worth $52,000 from an assessment value of the county. When what they're basically saying, hey, the land's worth maybe $52,000. So that's what they said there. And that was at, let's just say, January 1 of X1. Then we get to January 1 at X2. And what they did was they looked at the property and go, okay, the land's value's probably gone up because now there are homes here. It's not just a barren land. And there's structure, there's a foundation, there is the frame of the home. At this point, there was probably brick on the home. I don't know if there was an actual roof because this is about almost the time that it was not complete, but getting there. There may have been a roof on it. So the assessors came out and they said, okay, well, the land's worth, in this case, $9,000 more. And we're going to assess the actual home at $139,230. Combined, we see that the appraised value here went from $52,000 to $200,490. So we're seeing that increase, but the home wasn't complete on this day. Now, it was complete a couple months after that, and then in March, I purchased the home, and what I purchased it for $329. So I purchased it for $329, and so we're going to use that as a basis. Honestly, I don't know what it's going to be assessed at on January 1. We're not there yet, but when we get there, I should have an assessment number to see what that's worth the next year or the following year. But for illustration purposes now, we're going to assume that this house will be assessed by the assessor in my county at $329,000. So we have some gap here. Now let's take a look at what that property tax looked like over the year before I purchased it, the year that I did purchase it, and the year after I purchased it. So a year ago, before I purchased it, when we just had barren land, this is kind of what the calculations would have been. It was assessed at $52,000. The tax rate in my area is 2.151% of the assessed value. So in this case, it's $1,118.52. So the builder who built this home paid the county $1,118.52 in property taxes for that first year. That shakes out to $93.21 a month. Now, let's take a look at what this looked like in the year that I purchased the home. So when I purchased the home, the assessed value was $200,490. Again, applying that 2.151%, the property taxes went from $1,118 to $4,312.54. What we're seeing here is that the per month basis of that went up to $359,038. Now, what happens the year after? So the year after, this is what happens. We assume that the county will assess the property at $329. We don't know that. It probably will assess for less than that, but $329. If we apply a 2.1% tax rate, we get $7,076.79. So my property taxes the year after I acquire the property is going to jump up to about $589.73 a month. So that right there is a huge jump. It's a huge leap there that we have to understand why my mortgage might go up next year. It's because of this amount. Now, if we were to break down my mortgage payment, and this is my mortgage payment, so yeah, it's real life, in real life, right? So this is kind of how it breaks down. So if in the year of the purchase, my principal and interest was the year before purchase is $1,338.89. Insurance escrow, we're going to estimate at $75.74. And then I just calculated that insurance and tax, or the tax escrow, of $93.21. So that gives me a mortgage payment of $1,507.84. Now, that is all make-believe numbers because I didn't buy it that year. What happened when I did buy it? This is what happened. So my principal and interest was $1,338.89. The insurance part was $75.74 a month. And then the tax escrow was $359.38, which would give me my monthly mortgage payment of $1,774.01. Now, beyond that, what's going to happen next year? Well, we're going to use the same numbers here, and we're going to use the same numbers here. The only thing that's going to be different is this bottom number here because of the increased assessed value of my home. So if we look at what that looks like my mortgage is going to go to $2,004.36. So that is a significant jump here from the year that I purchased it. That amount is $230.05. So my mortgage payment is going to go up $230.05 because why? Because the assessed value when I purchased it was at $200,000. I purchased it for $329,000. And so when we come back around, when we actually have a home on the property, the assessor is going to assess it for a higher amount. In this case, $230.05 per month. It's a shocker. And honestly, that's a lot of money. But that's what happens when you buy a property in Texas. So now, besides that, now that's just, I mean, a lot of this is all make-believe here, especially because we don't know what happens the year after purchase at this point yet. But I also want to give you a real idea of what this might look like. And there was a little bit of adjustment from my mortgage company because they definitely adjusted this to be more than $359 to create a reserve, to create a padding so that they have enough to pay my taxes at the end of the year. So when I took out the loan for my home, this is the projection sheet that they gave me. They said that the estimated cost of my escrow account, so this would include insurance and taxes, would be $6,641.16. It says right here it's for hazard insurance, which is your homeowner's insurance, and for county taxes paid in reserve. So those are the two things that this $6,641.16 is going to go to. Now, if we were to break that down here, $980.88 went to home insurance. I know that because I'm the one that picked it and I have the invoice for that. And the rest would have gone to the expected tax escrow account. So those are the only two things that are in my escrow account. Now, if we appraise my property at purchase price and the tax, we said that the tax will be $7,076.79, giving us a difference here of $1,416.51. So in this case here, because my mortgage payment, my mortgage company assumed a higher tax, this difference is not as critical as the one that I just showed you in the last screen. But I still have a shortage of $1,416.51, which is basically $118.04 per month more that I should expect to have to pay. Now, to give you a complete picture here, here's my numbers simulated. So mortgage in year one was $1,892.32, and that's because they, again, inflated my property taxes to kind of get me close to what it should be. So $1,892.32. My property tax shortage, based on the calculations that we did, was $118.04, which also means that my expected year two mortgage is going to be $2,010. So it's not going to be under $1,900, is now going to be just over $2,000 because of this difference in assessed value. Now, this does not include any adjustments necessary for escrow reserves, which will need to go up, and an increase in homeowner's insurance. So if my homeowner's insurance goes up, this is also going to go up as well. But I've got another video where we talk about what components go into a mortgage payment. Now, again, reasons why mortgages go up, usually it's these two reasons. The assessed value goes up. So if your assessed value goes up, that means more value is being used to calculate your taxes, which means your taxes go up, and that then feeds into your mortgage payment. And the other reason is that your homeowner's insurance goes up. Now, again, you have choices here for homeowners insurance. So if it goes up too much, you can always shop around to other insurance companies and see if you can lower that. And if you can lower that, that might offset some of the increases that happen right here. Now, this also assumes that you have a fully amortizable loan with a fixed interest rate. And the reason why that's so important is if you don't have a fixed interest rate, if you have an adjustable interest rate, that means your interest rate might fluctuate at certain points in time, which also will increase or decrease your mortgage payment amount annually due to that change in interest rate. But most people have a fixed 30-year or even a fixed 15-year. And really, the two things that are going to make their mortgage payment go up is going to be their home insurance cost or their assessed value going up, which as a byproduct will also mean that the property taxes will go up. So that is a look at property taxes on new constructions here in Texas. I know there was a lot of things that we were looking at. At the end of the day, what we're saying is that when we assess the value in the year that you purchased a property, there may not have been anything, or there might have been very little on that property on January 1 when the assessor assessed your property. That assessment then calculates the taxes for that period of time. But then when the home is finished and you buy it, that following year, that assessed value is going to go up significantly. And as a byproduct, your property taxes are going to go up. And if that happens, you're going to have to come out of pocket in order to be able to pay that. And how do we do that? We do that by adjusting your mortgage payment. And I'm not doing it, but your finance company will do that annually, where they're going to adjust your mortgage payment based on the actual expenses they incurred for property taxes, home insurance, and then if you have mortgage insurance or private mortgage insurance, that might have an adjustment there as well. So that is our discussion here on property taxes on new construction. So if you're looking to buy new construction, just understand that your property taxes may go up, and they may go up in a significant manner, which it's going to have an impact on your mortgage payment amount each month. So hope you enjoyed this lesson. What do you think about this idea of new construction costing you more in the long run? Put that in the comment section below. If you liked this video, make sure you press the like button. Don't forget to subscribe and turn on the notification bell. That way you are alerted the next time I post a new video to this channel. And if you know someone who just purchased a new home, make sure you share this video with them so that they're not surprised when they get a mortgage letter update telling them, hey, your mortgage is going to increase by 10%, and the reason why, this is the reason why. So until next time, we'll see you in the next video.